Assalamu alaikum dear students. Today we will solve problem number 8 and 9 of chapter number 7. These problems are taken from Financial Reporting and Analysis 12th edition by Mr. Charles Gibson. Let's we start with the solution of problem number 8. Here we are given with some items of income statement, and first of all we need to compute the time interest earned ratio for 2009. Let's we get start with the computation of time interest earned ratio. So for calculation of time interest earned ratio, we need to have the earning from the recurring items, excluding the interest expense, excluding the tax expense, excluding the equity earning. So here you can see that we have earning from continuing operations before income tax and equity earnings. So here we will take this value, but we have to add back the interest expense so that we can get the earning before the interest expense, income tax expense and equity earning, plus interest expense, and then we will get it divided with the interest expense, and then we can get the time interest earned ratio, which become equal to 2.98 times. This is about the first requirement. And second requirement is to compute the time interest earned for 2009, including the equity income in the coverage. So here we need to calculate the time interest earned ratio, but this time we need to include the equity income in the coverage. So here you can see that it is the earning from continuing operation, but after the deduction of tax expense and the interest expense. So we need to add back the values of interest expense, which is 37,646,000, and we will add back the income tax expense, which is equal to 37,394,000, and we will get it divided with the interest expense, which is 37,646,000. So here now this time the time interest earned ratio will be 3.72 times. This is about the calculation of second requirement. And in the third requirement, it is asked what is the impact of including equity earning from the coverage. What is the impact of including equity earning? So here you can see in the second ratio we have included the time interest, we have included the equity earning in the time interest earned ratio calculation, but in the first ratio we have not included the equity earning. So we can say that including the equity earning in the time interest earned ratio gives us the least conservative measure of this ratio, while excluding the equity earning from for the calculation of time interest earned ratio can give us the more conservative value of this ratio. And the second point is, why should equity income be excluded from the time interest earned coverage ratio? Why it is so? Because usually the cash dividend received from the related investment are less than the equity income. That's why usually the firm cannot depend on this kind of income to cover their interest expense. This is the reason that usually the equity income is not included for the purpose of calculation of time interest earned ratio. It was all about the problem number 8. Let's we move toward the problem number 9. Here we are given with the income statement and balance sheet of two different companies, Allen Company and Barker Company. We can call it as A Company and B Company. And after the balance sheet and income statement, we are given with some industry averages. Industry averages of time interest earned ratio, debt to equity, and debt to tangible net worth. Let's move toward the requirement. The first requirement is compute the following ratio for each company, and first ratio is time interest earned ratio. let's we calculate the time interest earned ratio for time interest earned ratio. As we all know that time interest earned ratio formula is EBIT divided by interest expense. So for the A company, we need to have the EBIT. So you can see that net income is given, but this net income is after the deduction of interest expense and income tax expense. So what we need to do, we need to add back these both expenses in the net income. 43,000, which is the net income, we will add back the income tax expense 42,000 and the interest expense 10,000, and then we will divide it with the interest expense, which is 42,000. Sorry, the interest expense is 10,000, not the 42,000. 10,000, and then we will get the time interest earned ratio of A company, which becomes equal to 9.5 times. Let's move for the B company, and for the B company, net income is, here you can see 43,000. We will add back the income tax expense 65,000, and then we will add the interest expense 32,000, and then we will get it divided with the interest expense, which is 32,000, and then we can get the time interest earned ratio for B company, which becomes equal to 5.3 times. All right. And then what is our second requirement? In the second requirement, we need to calculate the debt ratio for both companies. So here, first of all, we will write the formula to calculate the debt ratio. Debt ratio is equal to total debt divided by total assets. Initially, we will calculate the debt ratio for A company. So let's search the amount of total debt. Here you can see in the balance sheet we are given with the account payable and bond payable. All right, if we sum these both amounts, account payable and bond payable, then we can get the total debt of that company. So for the A company it will be 1,60,000, and for B company it will be 165 plus 410, 575. All right. So let's move toward the calculation of debt ratio for A company. The total debt for the A company is 1,60,000 and divided by total assets are of A company, which are 3,56,000. 3,56,000. So the ratio becomes 44.9%. Let's move toward the calculation of debt ratio for B company. So the total debt of B company 165 plus 410, which is equal to 5,75,000 divided by the total assets of B company, which are 9,85,000. And then we can easily get the debt ratio for B company, which is equal to 58.4%. Let's move toward the third requirement, which is the debt to equity ratio. So here we will write the formula to calculate the debt to equity ratio. Total debt divided by total shareholder equity. So for the A company, debt will be same as we have calculated before, 1,60,000, and then we have to get it divided with the shareholder equity. So here you can see that we are given with the preferred stock, common stock and retained earnings. So if we make sum of these three values, then we can get the shareholder value of that company. So 1 lakh plus 50,000 plus 46,000, 1,96,000 will be total shareholder equity of that company. So the ratio will be 81.6%. And let's we move toward the B company. For the B company, total will be just same. Total debt will be same as we have calculated before, 5,75,000, and get it divided with the total shareholder equity, which become equal to 30,000 plus 2,80,000 plus 1 lakh. So it becomes the 4 lakh and 10,000, and the debt to equity ratio for B company will be 140.2%. Let's we move toward the next ratio, which is debt to tangible. Sorry. Here is the fourth requirement, debt to tangible net worth ratio. We need to calculate the debt to tangible net worth ratio. So the formula is total debt divided by shareholder equity minus intangibles. Let's we calculate for A company. The total debt will be just same as before, 1,60,000 divided by shareholder equity as we have calculated before. Shareholder equity for A company, which is 1,96,000, and we will subtract the intangibles. Here you can see in the asset section we are given the intangibles 11,000 for A company and 20,000 for B company. So we will deduct the amount of intangibles for A company. So our ratio will become 86.5%. Same method we will apply for the B company. The total debt is same as before, 5,75,000 divided by shareholder equity, as previously we have calculated the shareholder equity for B company, which is 4,10,000, and we will deduct the intangibles, which are 20,000, and then we can get the debt to tangible net worth ratio for B company, which is 147.4%. Let me see what is the next requirement. Okay, in the B part, there is a question, is B company in a position to take an additional long-term debt? If we look at the time interest earned ratio of B company, it is 5.3 times, but industry average for time interest earned ratio is 3.2 times. So the time interest earned ratio of B company is far less than the industry average. So we can say that Barker company, the B company, is not in a position to take an additional long-term debt because he will not be able to pay back its debt and the interest expense. And same we can see that the debt ratio 58.4, it is also greater than the debt ratio of industry average 40.3, and debt to equity ratio is 140.2, which is also more than doubled of the industry average 66.6. And same for the last ratio, debt to tangible net worth ratio. For the B company, it is 147.4%, which is far greater than the industry average. So it means already B company has a huge amount of long-term debt in its capital. So that company is not in a position to take additional long-term debt. The last question is, which company has the better long-term debt positioning? Obviously, A company is in a better position as compared to B company. We can say after comparing it with the time interest earned ratio, which is 9.5 times, it is not only greater than B company but also greater than the industry average. Likewise, the debt ratio, debt to equity ratio, and debt to tangible net worth ratio also gives the same a result that A company is in a better position as compared to the B company. Thank you so much.